I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White and my guest today is Victor Rodriguez. Victor is Head of Fixed Interest at CIP Asset Management. Welcome, Victor.
Thank you, Peter. Thanks.
Let's start with the thorny issue of credit, your bailiwick. It seems that institutional investors understand and know credit, but why is it that both mum and dad investors and even the financial advisory community are sometimes wary of it and don't seem to have a bigger handle on it as others might do? Certainly not their institutional cousins.
Yeah, it's a good question, Peter. And at CIP Asset Management, we've been managing money for institutional investors for over 15 years in that credit space, and are only now just venturing into the retail market. Institutional investors have looked at their overall portfolio and looked at the risks in that portfolio, ranging from the riskier equity market side of the portfolio through to much more defensive positions like cash and fixed income, but an understanding that they don't necessarily need to barbell that strategy quite so much as seems to have been the case in the retail market, where investors have been heavily focused on liquid equity markets, where mainstream media is constantly reporting, and so there may be some more familiarity, as well as those more defensive assets that you've seen like government bonds and even term deposits that were yielding in previous years somewhat more than they are today. And so, our view is that retail investors going forward should be more open-minded about layering the risks in their portfolio, not necessarily with a view to increasing overall risk, but rather just to diversifying the risks in their portfolio, and perhaps even contemplating the idea that not everything in their portfolio needs to be daily liquid. There might be opportunities to take advantage of what we refer to as illiquidity premiums to enhance yields, enhance longer term returns, but without necessarily being able to draw on liquidity on a daily basis.
Well, unlisted property trusts are illiquid, yet they seem to be understood more. So really you've got that job ahead of you of getting that understanding of liquidity or lack thereof into a new market.
That's a fair point, absolutely, Peter.
And do you think the awareness of credit-based investments is increasing across the board?
It's a good question. We're certainly working hard to educate the market about the risk-return profile. There's often a view that to source income, retail investors will look at equity markets and the dividends that can achieve, but the volatility of returns in equities far outweighs the volatility that you would have even in the riskier part of credit markets. Given that in terms of the company's corporate structure and capital structure, you rank above equity if you're a lender in that particular company, you would expect to have much more resilience in the event of a downturn, and that is always the case. And yet, many retail investors still think that high yield bonds, for example, might be too risky in the context of their portfolio, while they have half their portfolio sitting in equities. So it's interesting, and you're absolutely right to point to this idea of having to educate the marketplace around the merits of investing in credit, and indeed the merits of investing in private debt, which is a core competency at CIP Asset Management, where again institutional investors and to some degree high net worth investors have certainly been investing, but that wider market has been more reluctant so far.
So we could almost be in the midst of a very gradual sea change in terms of how credit assets are viewed.
Well, that's right, and I think it's interesting in so many respects. 2020 has proved an accelerator for change, whether in our daily lives and even investment markets.
By necessity.
By necessity, and there's no question that with interest rates now, a third of global government bond yields are negative now. Even the Reserve Bank is talking about another rate cut with only very little room left.
Where to?
And so investors, I think, are almost forced by necessity, as you say, to look at different alternatives to seek that income going forward.
Now, your flagship fund, since 2017, 97% of the months of performance have been positive. Can you tell us why and how?
No, absolutely, and I certainly want to congratulate and highlight the quality of my investment team, but maybe first of all to highlight the features of that fund. It's the CIP Asset Management Credit Income Fund, and the way we designed that fund is truly innovative in that it combines more liquid public credit instruments with private debt instruments in the portfolio. Because it has those less liquid private debt instruments though, it doesn't offer daily liquidity. It offers monthly liquidity to underlying investors. So you have to give up a little bit in terms of that liquidity profile as an investor, but to get the enhanced yields that you can. And private debt investments, for the same level of credit risk, are able to offer 1.5% to 2% greater yield, simply by being able to forego the need for daily liquidity, not taking more credit risk. And so the overall portfolio that we run is actually investment grade in nature, the average rating of the portfolio. So it's quite defensive. So even in downturns, the returns are relatively stable. And so that's been a key feature of being able to sort of achieve the returns we have. The other important point I'd highlight is by not having daily liquidity promised to underlying clients, when opportunities do arise that may be less liquid, as was the case in March, there were some funds that were desperately trying to seek liquidity by selling investments because unit holders wanted to exit.
At the wrong time.
And that extended, by the way, to institutional clients because you had, for example, the super scheme initiated by the government, and you also had, for example, impacts of currency depreciation, meaning liquidity needs of super funds and individual investors. And so all those needs for a daily liquid fund meant that the managers were almost fighting against the tide, having to sell into a bear market. Without having that commitment to daily liquidity, we were able to be much more choosy and selective without very much competition alongside us for assets that were still very, very attractive. It was essentially a case of the baby out with the bathwater in March and April because people weren't, initially at least, distinguishing between COVID-resistant names and those that are more genuinely impacted.
Well, let's talk about that flagship fund for a moment. What's the minimum investment and who can invest?
So we've introduced a retail share class now. So we have an institutional, a wholesale and a retail share class. And the retail share class now allows investments of $10,000. So that's been reduced recently. And so basically any investor who can commit to at least that size of investment is able to invest through our Fidante platform.
And what's the initial reaction to it?
Initial reaction's been very positive. We launched this fund just less than 3 years ago now. The fund is already now close to 300 million in assets under management, in part, of course, due to its truly innovative nature, but also to the returns that you highlighted. And we're now starting to get that momentum, particularly in that high net worth space. We're having a blend across the different credit markets, both public and private, is seen as a key feature of the fund.
Have traditional long duration government bond dominated fixed income strategies become fixed loss?
Yes, that's right. I was hearing something similar the other day around fixed income, all fixed but no income, and I touched on earlier the idea that many government bond markets are negatively yielding. That's not the case in Australia. Still positively yielding, and albeit just, and not the case in the US with treasuries. We would argue. Historically, there's been a very strong negative correlation between equity markets and those government bond markets that you refer to. So when equity markets were under pressure, as we saw, for example, during the GFC, government bonds yields were falling sharply and therefore prices were rising, providing some protection, some buffer to the losses in equities. Can that continue? Technically, yes, because if government bond yields move into negative territory, there can still be an additional benefit. But clearly, the risk-return trade-off there has well and truly diminished. The risks are asymmetric now, and you could certainly see an environment where, as that stimulus comes through, it's not a prediction because at CIP we don't try and predict macroeconomic factors, but if you saw an environment where a vaccine came through, but suddenly that's enormous unprecedented stimulus that you've seen from both central banks and from governments starts to maybe get pulled back, you could see an environment where inflation risks see equities sell off and government bond yields rise, i.e. government bonds sell off. So this idea of blindly relying on government bond investments to protect you through that inverse correlation against your growth assets in a downturn is very much fraught with danger going forward in our view.
Well, that leads me to the question of how has the credit sector evolved during the pandemic? presumably we're mid-pandemic now, but are there more opportunities or less, and are they priced attractively or fairly?
Yeah, sure. Well, I mean, just to pick you up on I'm a little bit more optimistic, hopefully, that we're past the midpoint of the pandemic, but certainly the news overseas has been quite terrifying almost in parts of Europe in the last few weeks. But in terms of what we've seen in credit markets, it's fair to say that credit markets, almost shut up shop there for the first few weeks of that sort of in March. And what we've seen since then is some interesting dynamics. For example, bank paper in Australia, major bank paper, has rallied incredibly, so that spreads are inside where they were pre-COVID. Banks have almost gone to, one arm of government, in terms of how they've been performing, what they've been asked to do in terms of their lending to underlying both individual and corporates on their balance sheet. So in that sense, the rally in that space has been unprecedented, but we view that as extremely expensive to own major bank paper in the Australian marketplace. Having said that, on the private lending side, what you've seen is you saw much less activity in those first few months. So a lot of the private lending opportunities that we source come, for example, through private equity firms and M&A opportunities. That's now starting to emerge. Instead of focusing in our portfolio construction meetings on the underlying portfolio for 90% of the meeting, now we're moving back to a focus certainly on the portfolio, but also on pipeline opportunities. And where we're seeing those opportunities, not surprisingly, are in those ultra defensive sectors like healthcare, like tech, where there's still some M&A activity going on, and there are opportunities for us to invest as lenders in what are very defensive names, but at very attractive yields.
Well, the March sell-off, of course, impacted every asset class. What surprised you most about how the credit sector has reacted or behaved? Or is there no surprise to you?
Well, it's a good question. When the news broke and markets reacted, if you had asked me, or if you had told me that spreads would be back at levels we see today, I would not have believed you. But with the bigger picture in mind now, the level of stimulus that we've seen from central banks has been absolutely enormous, and dwarfs what we saw in the GFC of 2008 and early 2009. So in that sense, that enormous injection of liquidity and the fiscal support that we've seen throughout the economy has meant that to some degree it does make sense that you've seen this pullback in spreads, albeit going forward, an active approach, managing portfolios in a way that tries to distinguish between those names that are going to be more heavily impacted and those that are more resilient is going to be critical.
The scale of dividend cuts that have occurred during this period have been quite large, and have reminded, I think, many people that the ultimate owners of companies are the bondholders and the lenders. Should credit be considered a dividend replacement?
I think for the underlying investors, quite frankly, credit should be almost a cornerstone of any income-oriented strategy, much more so than dividends. Obviously, dividends come with tax benefits around franking credits that can't be ignored, but the volatility in your share portfolio that comes from total returns also needs to be taken into account if an investor is primarily focused on income. So, in short, credit should be a cornerstone of any income-driven policy.
Your strategy invests across asset-backed real estate, financials, non-financials. Where do you see the greatest opportunities coming as 2020 closes in terms of what you're dealing in?
Yeah, no, that's a fair question. I'd introduce an additional layer, as I've touched on earlier, across all those asset classes that we invest in. The Credit Income Fund invests in all of those, both in public markets that are more readily tradable, and private markets that are, are more bilateral in nature in terms of the loans that we engage in with our borrowers. So the way I would demonstrate or highlight value is focusing much more on the private side rather than the public side. And what you've got is a dynamic which, to be honest, began well and truly before COVID-19 took off, which is that banks who've dominated the lending markets of Australia have been pulling back quite a bit in terms of their appetite, not necessarily because of risk, but because of Capital, the increasing cost of capital has meant that they've been more cautious, they've had to rein in. And so non-bank lenders effectively, like us, of which there are not many, have really been able to step in and fill the void for very relatively low risk opportunities, but at very attractive yields. And that remains the case today. There's been no change from COVID about banks and their cost of capital.
Could we summarise where we are at the moment, that traditionally fixed interest was seen as government bonds or government or semis, but really now fixed interest is a much wider domain, and with particular focus on private and corporate?
Yeah, I think it's probably fair to describe it that way in Australia, where the corporate bond market has struggled to really grow at the kind of rate we've seen in other markets, where bank disintermediation has been far more prevalent, both in the US and Europe. So I'd agree with you. And the big opportunity going forward, as you highlight, is for investors is going to be in that private lending space, because those opportunities, we're not short of opportunities. Our decline rate, for example, in that space is over 90% in terms of deals that we get shown and decide not to invest in. So there's no shortage of supply of opportunities, but it's more a case of making sure that you're actively choosing the right ones.
Well, glancing at your crystal ball for a moment, 5 years' time, what will the Australian investors' opinion look like of credit assets and opportunities?
Yeah, that's a good question. I'd like to think that high net worth is already there, I think, but the retail space starts to think a lot more like institutional investors, thinking about the framework of their investments in a more layered fashion, such that credit represents a bigger component, and understanding, I think, that the need for daily liquidity is perhaps overstated, and most importantly, comes at a cost, a very significant cost that may not be fully understood on day one.
1 month liquidity is not a lot to give up, is it, for a significant
not
increase
really,
in return?
But you'd be surprised how few funds in the retail space don't offer daily. It's very few, and so that's been one of the reasons, because we've initially focused very much on high net worth, where there's much more acceptance of that, and that's a primary focus for us. But in that retail space, you would think that shouldn't be an impediment, and we'll see how that education process rolls out.
It's almost
in
if
coming months and
the
years.
daily liquidity requirement is a handbrake.
As an investor, very much so. As an investor, basically, you're managing a pool of assets, but very mindful of the liabilities you have, and the liabilities are the needs of your underlying unit holders. And if they are daily liquid unit holders, there may have been cases where in the search for yield, fund managers maybe have stretched the envelope, even though their clients are demanding daily liquidity. We haven't had to worry about that, or we certainly wouldn't do that in any case, but the idea of having that less liquidity, we've got another fund that's open at the moment only to institutional investors that offers only quarterly liquidity. So for us, it provides a degree of freedom that allows us to attract opportunities that others cannot, with that constraint of daily liquidity. And we've got to get that message, as you say, Peter, out to the marketplace so that they can understand, because I don't think they've really been able to quantify the cost, or even thought there's a cost with being in daily liquid. But that illiquidity premium is very real and has been reasonably consistent over many years.
Is it compressing or is it expanding?
It's expanding, and one of the reasons for that, I think, is like I said earlier, that banks have less appetite. So corporate borrowers, real estate opportunities, and even in that asset-backed space, there are opportunities there from borrowers looking to diversify their funding base, and therefore in many instances having to pay for that as the reluctance from banks comes through. So it's expanding, not massively, but the average, to give you an example, your average BB corporate loan that we would look to invest in gives you a 2% higher yield than a similarly rated public corporate bond. So similar risk, all else being equal in terms of credit, but obviously less liquid because it's a private loan. Now, 2% in this world, for introducing a new type of risk, but it's not credit risk, it's illiquidity risk. So if illiquidity risk is something that the underlying unit holder investor can more easily identify and understand on day one, in terms of, well, can I take the benefit of this extra 2% yield? do I have the appetite for that illiquidity risk or don't I? It should be a much easier decision than trying to quantify how much credit risk at what point of the cycle you're looking to take as an investor. If that
So
makes
this
sense.
whole liquidity risk seems to me like a major conversation going forward.
Absolutely, absolutely, Peter.
Victor, thanks for your time today.
Thank you, Peter.